Are you staring at a mountain of study material for your life insurance exam and feeling, well, a little overwhelmed? I get it, you're not alone. But don't worry, in the next few minutes, we're going to cut through all that noise. We'll build a super simple framework so you can nail these concepts and walk into that test feeling totally confident.
All right, let's just jump right in. Seriously, put down the flashcards for a few minutes. We're about to create a mental map of these policies that's going to make the right answers practically leap off the page when you're sitting for that exam. You ready? Let's do this. Okay, here it is. This is probably the single most important thing you need to lock in right now. Almost every single policy question you'll face on that exam boils down to this one simple idea. Is the coverage temporary or is it permanent? If you can get this down, trust me, you are already halfway to the finish line. So to make this temporary versus permanent thing crystal clear, we're going to use a really simple analogy. Think about it like this. Temporary insurance is like renting, and permanent insurance is like buying. This one little concept, it's going to be your secret weapon for a ton of questions on the test. And look at this. It lays it out perfectly. On one side, you've got term life. That's your rental. Lower cost to get in, you get that pure death protection. But it's temporary. It has an end date. On the other side, whole life. That's like buying a house. Yep, it costs more, but you're building equity. That's your cash value. And the coverage, it's permanent. It's yours for life.
All right, let's dive a little deeper into that first category. We're starting with the renting model, which is term life. Just keep this in your head. Term is all about getting the biggest bang for your buck, the most coverage for the lowest price, but only for a specific period of time.
So for the exam, the biggest clue is right there in the name. Term insurance has you guessed it, a termination date. It's pure, simple protection. It only pays out if you pass away during that specific term. That's it. That's why it's so affordable. No cash value, no fancy bells and whistles, just a straight-up death benefit. Now, within term life, you'll bump into a few different flavors. First, you've got level term, super common. The name says it all. The premium and the death benefits stay level or fixed. Then there's decreasing term. Think about a mortgage. As you pay it down, the amount you owe decreases, and so does the coverage. It's perfect for covering a specific debt. And you can probably guess the last one. Increasing term does the exact opposite. The coverage amount goes up over time, which is great for things like fighting inflation.
Okay, lean in for this one, because this is a classic exam question that trips a lot of people up. Renewable versus convertible. Renewable term means you can continue your policy without a new medical exam. Easy, right? Convertible term means you can convert or switch it to a permanent policy. Again, no new medical questions. But here's the kicker for both. The new premium isn't based on your old, younger age. It's based on your attained age, how old you are now. That is a huge point to remember.
And this is exactly why that attained age thing matters so much. A 25 grand policy for a 7-year-old, it's going to cost next to nothing. I mean, pennies. But that exact same policy for a 57-year-old? Whoa, the premium is going to be way, way higher. So when you renew or convert, that price is going to jump. Because frankly, the insurance company's risk has jumped right along with your age.
Okay, so we've covered renting our coverage with term. Now let's flip the script and talk about buying it. This brings us to the world of whole life, which is all about permanent, lifelong protection. So what's the deal with whole life? Think of it as having 3 main parts. First, it's permanent. It's designed to last your whole life, until you pass away or the policy matures, usually at age 100. Second, and this is a big one, it has living benefits. That means it builds up cash value that you can actually borrow against while you're still alive. And third, that premium, it's level. It's locked in and will never, ever go up. Yes, it's more expensive than term, but remember, you're buying an asset, not just renting.
So if the benefits are pretty much the same, what's the difference between all these whole life policies? Well, it all comes down to how you pay for it. Straight life is the standard model. You pay the same premium your entire life. Simple. With limited pay, you pay higher premiums, but only for a set amount of time, like say 20 years, or until you turn 65. Then you're done. And finally, single premium is exactly what it sounds like. You pay for the entire policy in one big lump sum up front.
Okay, so now we've got our 2 main building blocks, right? Term and whole life. Now let's look at some of the specialty policies that kind of mix and match these blocks. And you're definitely going to want to know these for your exam.
All right, another one to watch out for. These two sound almost identical, but they're not. The absolute key difference is when the clock starts ticking on those income payments. For a family income policy, the countdown begins the day you buy the policy. So if you have a 20-year policy and pass away 5 years in, your family gets income for the remaining 15 years. But for a family maintenance policy, the clock doesn't start until the date of death. So if you pass away, your family gets income for the full 20-year period starting from that day. See the difference? It's a big one. Here's another classic exam pair-up. Joint life versus survivorship life. The easiest way to remember this is by their nicknames. A joint life policy is often called first to die. It pays out when the first person on the policy passes away. Think of business partners who need cash to buy out the other's share. Survivorship life is the opposite. It's called second to die. It doesn't pay a dime until the last person on the policy dies. This is huge for estate planning, to cover estate taxes after both partners are gone. All right, we're in the home stretch. Let's finish up with two super important regulatory topics that you are almost guaranteed to see on your exam. MECs, which stands for Modified Endowment Contracts, and variable products. And hey, knowing this stuff isn't just about passing the test. It's about being a compliant professional agent.
So what on earth is an MEC? Put simply, it's a life insurance policy that you funded with too much cash, too fast. See, the IRS created this rule to stop people from using life insurance just as a tax-deferred investment vehicle. So if you cross their line, the policy gets reclassified as a modified endowment contract, and the tax rules change.
And how do they decide if it's a MEC? They use something called the 7-pay test. It's actually not that complicated. Basically, the IRS figures out the maximum annual premium you'd need to pay to have the policy fully paid up in 7 years. That number becomes the limit. If, at any point during those first 7 years, the total amount you've paid in goes over that cumulative limit, bam, your policy becomes a MEC.
So what happens then? Why do we care? Well, here are the penalties. As soon as a policy becomes a MEC, any withdrawals are taxed on a LIFO basis. That's last in, first out. In plain English, that means your gains come out first and you pay ordinary income tax on them. And if you're under 59.5, you get slapped with an extra 10% penalty. Basically, those awesome tax advantages of life insurance, they go right out the window.
And last but not least, let's talk about variable products. These are policies where the cash value is invested in things that act a lot like mutual funds. The growth potential is higher, but there are no guarantees. And for your exam, the number one thing you have to remember is this. With variable products, the investment risk shifts from the insurance company to you, the policy owner. You're the one taking the risk. And that, by the way, is why you need a securities license on top of your insurance license to sell these. And that's a wrap on our quick and dirty review. We've hit the main types, term and whole, we've looked at the hybrids, and we've covered those key rules. So be honest with yourself for a second. What's the one thing we talked about that you know you need to go back and review? Pinpoint that, hit the books one more time, and keep this momentum going. You've got this, you're going to crush that exam. Good luck.